Hello, everyone. Welcome to Friday. As always, it is another opportunity to talk about the market and review our Rebel Income trades. Grateful to see those of you that are here as we get things rolling. Hopefully, we'll get a few more coming in as things get going. As always, this is we're doing this on Friday morning as the market opens and as activity is getting started in the marketplace to finish the week. Uh, Part of the reason for that is because there are always weekly options that are expiring, and that means that there are often opportunities to review some of the trades that we've been placing in Rebel Income. Good morning, Gib. Welcome. Thank you for being here. So we can review the trades we've been placing and try to evaluate if there are opportunities to make adjustments, if there are decisions that need to be made about these trades and changes that need to take place, or if we can simply maintain course and keep things going as we have. So this is also an opportunity. I think today we've really only got a few positions to really talk about on the open side. That means that I expect we'll have some time to go over not only to answer questions that you may have, but also to review some things that in the marketplace that you may be interested in sharing with other people. So that'll be a fun opportunity. Just by way of introduction, for those of you who may not be as familiar with the Rebel Income investing method and with kind of the format for this live stream. Rebel Income is an income generation investing system that focuses on identifying stocks that pay consistent dividends that are running at deep discounts. So we're talking about value-focused dividend paying stocks that are also fundamentally very strong, and then we use those stocks to generate income by selling options against them. Most traders, when they think about the options market, they really think about it strictly in buying terms, what I call directional terms. If you think a stock is going to go up, you're going to buy a call option. If you think the stock is going to go down, you'll buy a put option. I like to reverse the script, and instead of always being on the buyer side of things, I prefer to be the seller of those contracts. Why? Well, because the truth is that my own experience, as well as a lot of personal study, have shown that these directional strategies, just simply trying to buy on the hope that a stock goes up, or opposite with a put option if you think the stock's going down, those are strategies that have a very low probability of success. On average, that's only about 25 to 30%. And I'm not just talking about my own trades. I've talked to a lot of other investors who have indicated the same kind of results, and seen a lot of studies that prove that out on a historical basis as well. So with Rebel Income, what I'm trying to do here is to reverse that script. If the probabilities are so poor by taking the long side of the market, then it stands to reason that the probability should be better for the people that are taking the short side. I'm not talking about shorting a stock. When I say short, I'm talking about the people that are on the sell side of these transactions. So once we've identified a stock that is deeply discounted, is paying a reasonable dividend, and has a lot of good core fundamental strength to it, that implies that there is an attractive value proposition to be had, then the method for the trades that we place is to sell a put option. Why a put option? A put option gives the option buyer the right to force the seller to buy the stock at a set price. Now, that only happens if the stock drops below the strike price that we've sold. But what that does for the put seller is it sets up an opportunity not only to generate immediate income from the put sale, but also if we're talking about fundamentally strong stocks, deep discounts, and useful dividends, it also set up a nice opportunity to own a stock that you may already be interested in the first place. But instead of simply trying to manage a purchase price around whatever the market is doing, the put sell gives us a little bit of control over the price that we're willing to pay for the stock. Now, those assignments in just over the course of the last 10 or 11 years since I started publishing my trades with the Rebel Income System, those assignments come probably 25-30% of the time, but they also kind of come in batches, so they do happen. But by and large, by selling put options with very short-term expirations, we're usually working within a month or less to try to increase the number of trades we can place every year, and by so doing, create a compounding effect from the income from our trades. By doing that, we're actually increasing the probability of success by quite a bit. And I take a put assignment where I'm forced to buy the stock as part of that calculation of success. I don't consider that to be a failure, because that gives me an opportunity to own a stock I like anyway. If I hold it through a dividend declaration, I get the opportunity to bring in that passive income. And if the stock does remain anywhere near the price that I bought it at, there's usually other opportunities to generate additional income with covered calls. So that's kind of an overview of what we're trying to do with Rebel Income. And so the trades that we focus on, the stocks that we're going to be talking about over the rest of this session, are really, we're looking at them through that lens and trying to see how current conditions are impacting that decision to generate income with those stocks. And so we'll talk about some different variations on some different ways you can apply the method versus what you see me write about. But there's kind of the nuts and bolts of what we're doing with Rebel Income. So with that said, let's go ahead and dive in, and let's talk about what's on deck. We've had the last couple of weeks, the momentum in the market has been pretty positive, and that's created some nice opportunities to unload some stocks that I had been holding. We have covered calls that took place here earlier this month. Here's Borg Warner, Barrick Mining, Delta Airlines are all stocks I was recently called out of on covered calls. These were stocks that I had been assigned from put sales and was able to bring in some nice returns from the premium from the put sale, from covered calls, and from dividends as well. And even in some cases, some fairly attractive capital gains as well in all three cases. That part is not necessarily typical to see the stock move far enough away from the price that I was assigned when I place a covered call to realize $2 or $3 above the price that I sold, or excuse me, $2 or $3 above the price that I bought the stock at. It's usually either somewhere between at the same price or maybe $1 above, and that's about it. So some of these have been kind of nice to see and given a nice little boost here. But for now, what is left? Really, I just have two put sales and a covered call another covered call that came up this week on Schlumberger, which is a stock that I was assigned at the beginning of August, and it moved a little bit above that price. I was assigned at 35. It moved a little bit above that price earlier this week. But let's talk about the put sales first. Last week we placed a put sale on an energy stock that I like quite a bit. It's Coterra Energy, stock symbol CTRA. and this one expires on the second Friday of September. So we are, that was a 24-day trade. So that was actually not correct when I, 23, number of days on that one was incorrect. I apologize. Still a couple of weeks to expiration on this one. But I sold the $23 strike price and brought in a little over 2% in premiums at 49 cents per share. So the $23 strike price is kind of the benchmark that we want to pay attention to. Let's go ahead and go to our charts and see what is what. Okay, oops, not the stock I wanted. This one is. Okay, there we go. So my strike price is at $23 at the bottom end of Coterra's, really the low end of their range over the last couple of months. And we can see the stock is showing some nice momentum over the last couple of weeks, up now near 24.50. It's not a really long way away from 23, so it could certainly drop back down towards that level in the next couple of weeks. But I'm really encouraged by this strong support level. We've got really one, two, got a double bottom forming here, and if we can get a break above this pivot high that came earlier this month at about 24.50, we're very near that right now. If we can push above that, then this could easily reverse the stock's longer downward trend that has pushed the stock down a little bit since March. So this is interesting, and this drop, in all fairness, is part of what gave us the opportunity to work with this put selling trade. So this consolidation range down here is really kind of an ideal setup for what we want to do with income generating kinds of trades. Not necessarily because we're anticipating a breakout. One of the things that some people do with put selling is they try to use the put sales as opportunities to time short-term swings in momentum and sentiment, which is fine. They kind of use it as a swing trading method instead of buying the stock or buying a call when they're expecting a short-term bump. And I get that. That's not what we're doing with Rebel Income. We're taking a much longer-term view, and that means that while we may see some benefits from short-term swings in our favor, we're really trying to focus on what the opportunity is right now to generate that income, and then accepting the result of what may come afterwards. It's really about, is the stock's value proposition high enough at the price to justify the trade? And that means, am I willing to buy the stock at the price that I'm selling? So when I sold $23, this was a tacit acknowledgement that if the stock is below that price at expiration, I'm okay with owning the stock. I'm going to take that assignment. Right now, it looks like that's not the case. But if this consolidation range holds, and that just starts to extend the current trend even more in a sideways direction. I'm using dotted lines here to kind of illustrate this short-term sideways trend. If that continues to hold, that consolidation range will actually be that'll be just as productive for our purposes as anything else. Consolidation ranges give us a lot of opportunities to place a lot of functional trades, either with put sales or with covered calls in the event that we do get assigned, as long as the consolidation range holds. So these are productive kinds of patterns for the trades that we like to place. So we'll see where this goes, but this does mean with the stock a little bit above 24.50 that we have an opportunity to evaluate what's going on and see if there's something that maybe we can do differently with the stock. So let's go ahead and take a look. And by the way, if any of you want to share the numbers that you've been able to get with the same trades, if you have placed the same trades that I have, please do. I apologize. I was distracted for just a minute. Okay. Here's Coterra. There we go. Thank you, Barry. Barry brought in 52 cents. I brought in 49 cents. That means Barry won. Nice job. Okay. Here is the contract that we're talking about. This is the $23 strike right now for the September 12th expiration. Oops. Okay. The asking price on this is 15 cents. Why am I making note of that? Well, because again, some people are going to apply this put selling method a little bit differently than I do. My method is simply set the trade and then let the result be the result. I'm going to hold it through expiration and see what happens. It doesn't mean that I turn a blind eye to the stock's price action in between. It just means that I'm content with holding the put option for the time period that occurs, and then I'm not afraid to accept the result. But the stock is also seen enough positive momentum here that it's nicely above the price that I sold, the $23 strike price, and that has created an interesting opportunity here. Maybe not as big for me as for Barry, for example, but I brought in 49 cents when I sold this put option. The contract is now the asking price on this is now 15 cents. Let's just take a look at the details, see what kind of, there's not a ton of open interest, but a little bit. There's been no activity so far today, but again, we're only a few minutes into the trading session so far. There's our $15 ask, 15 cent, excuse me, 15 cent per share means $15 per contract. So what this means is that I could buy this contract back right now. I've had this trade for 9 days so far. And already the stock has seen enough movement that if I wanted to buy this back, I would pick, if I didn't want to monkey around with making the market come to me, I was just willing to take what the market is offering. I could go ahead and pay that 15 cents. There we go. And I'd still hang on to 34 cents of my premium. Is that good? Is that bad? Well, if we think about that on a $23 strike, that's still almost 1.5% in terms of total yield on the trade. So I'd obviously be giving back some of that initial yield to buy it back. But I also, in this case anyway, would be shortening the duration of the trade by more than half. Instead of a 23-day trade, it would be going to a 9-day trade. Well, what if you could do that every 9 days? Simplified assumption. But sometimes these things do happen where you have an opportunity to close out a trade way before expiration. And this is where some of the people in our group who are more active about managing their trades than what I do where where they can create an advantage. And here's where that advantage lies. Keep in mind 1.47% for 9 days. I'm going to show you how this translates for me and the way that I do this. I brought in 2.13%. This is a 23-day trade. Let's assume for a moment that I go ahead and do what I do, which is to hold the trade through expiration. The stock remains above 23, and this option expires worthless. Now that's a good result in my book. I'm happy, very happy with that result. But that means that the same capital that I put on reserve for this trade, which since I sold 2 contracts on this, is a total of $4,600, right? 23 times 2 is 46. 2 contracts, 200 shares. So $4,600. That $4,600 will not be available for me to use again until the trade expires and has settled. So sometime after, a couple of days after the 12th of September. I'm okay with that. That works. But here's what that generally means. So let's consider we got 365 days in a year. If I'm placing a trade every 23 days, then that means that I'm placing basically 15 trades per year. There's a temptation to average up. I'm not going to do that here. I'm going to try to stay conservative. So we're going to call that 15 trades. So I can do 2.13% every trade times 15 trades, then I'm doing about 32% per year. This is why I'm okay with this. This is in fact a great result on the capital that I'm working with. And that's very functional, and that's really functional is really all I'm after. I'm not necessarily trying to maximize my results. This is more than what I'm actually trying to get. I'm trying to average about 1.5% per month. So that's every 30 days, which only works out to about 18% per year. This is well above that. So this is a really, really nice result, assuming everything works out the way that I'm talking about. So keep that in mind, 32%. Well, what about this idea of rolling more actively? So we have this 34%, 34 cents by buying the option back, right? I have to pay the 15 cents that we already talked about. We divide that again by 23. So we have our 1.47% result, right? Now, 365 divided by 9, it means we could be placing up to 40 trades instead of 15. We're almost cutting that number in thirds, being able to place almost 3 times as many trades. Well, 1.47%. Yeah, there we go. Times 40 trades. Now the potential return jumps to almost just a little under 60%. What's the difference? Trading frequency is the answer. It doesn't necessarily mean that this is better. This is more. And it's easy to assume that more is better, right? So why aren't I doing this? I've gone through this illustration on many times before with other people over the years, and I've had some of the people who are in our group start screaming about why haven't I done exactly what I just outlined? So why not? The advantage here is that you're increasing your trading frequency, but also when you place more trades, you also lower your probability of success just a little bit. These trades are, again, this is not a criticism. This is just, we want to make sure that we understand all of the elements that are in place and how that impacts what the system is going to do for us. You're increasing your trading frequency, which also gives you an opportunity to increase the compounding effect that you get by leveraging trading frequency. I'm already placing more trades in a year than I normally did just by being an option buyer or a stock buyer. So I'm already using trading frequency to my advantage. And people who take this more active approach are leveraging that even more. But again, the probabilities usually come down. The probabilities right now for my trades, give me a second, sorry. Yikes. Probabilities for my trades right now, I've got about a 98% success rate. That's maybe a little bit of bragging, but it's really just showing you how effective this is. And why I focus on this method so much is because I've been able to reverse my probabilities over the last 11 years. These are is how long this track record goes back. I've been able to increase my probabilities by so much that it makes the old methods of trading nonsensical to me, practically. If you're taking the more active approach, most of the people that I've talked to, who are using put selling, but on this more frequent basis, they're buying well before expiration in many cases, because it gives them an opportunity to bring in, to increase their net result by almost double over the course of a year. Their probabilities also go down a little bit. Instead of being in the 90s, they're 75 to 80%, which is still very, very useful. And if you prefer the net higher effect of compounding that you're going to get by increasing your trading frequency, and you can manage that additional that additional number of losing trades, go for it. There's nothing that I've got. This is the reason that I'm talking about it and I'm demonstrating it, is because this is productive. This is really productive, and it's really useful for those who prefer it. But I love Gibbs' comment here. He says, "I always have the bird in hand thought," and that kind of cuts both ways, doesn't it, Gib? For me, the bird in hand thought means I've already got a really nice result. Why do I worry about trying to change it? The other flip side of that for the active seller is bird in the hand. I can already bring in one. I can lock up 1.5% right now. There's my bird in the hand, and then I get my money back and I can go redeploy it. So a lot of that, yes, I agree with that. Even that is open to interpretation, right? But that does beg the question: if you do decide that you want to manage this a little bit more actively, what do you do next? So if we buy this back, this immediately closes the obligation associated with that put selling contract. Trade settlement is also immediate. If you're to buy back the $23 contract today, and you have an open trade here on this, then as soon as that trade closes, the money comes back into your account and is available to trade. Now, the money hasn't left my account, but it is on reserve for the duration of the time that I hold this contract. And if I let it go through to expiration, that money will not be available for my next trade until after the trade settles, which is probably going to be about the 15th or the 16th of September. I go in understanding that reality and accepting it, and I'm okay with that because it's still functional for me. But pulling that money back, those $4,600 that I have in reserve, and being able to think about the next trade. Let's say that I want to keep working with Coterra. What else can we do? Well, here's the 24. If you go up just about $1, there's about 35 cents that's available there. If you extend out to the 19th, week 3, interesting. This is really exaggerated. There we go. That's better. 35 cents for 4 weeks. So not a really big difference and kind of a wide spread between these two. So I'm not sure that I love the options that are available for the next couple of weeks after the 12th on CTRA right now. But the capital still comes back to me, and I could redeploy it even if that means moving on to another stock. So what do you think? What are your thoughts, everybody? Yes, no? Do you have a different idea or a different opinion of what you might do or what you are doing for that matter? We'll come back to it if you want to put a comment in the chat area. We'll come back to that as soon as we have them. In the meantime, well, Barry, I'm staying put and I'm letting it play out, and that's kind of me, because this is the other reason that taking a little bit more of a passive, for lack of a better word, maybe conservative approach and letting it play out the way that you're saying, Barry, is the question. Gib, I'd have to go through the numbers before rolling, for sure. Need to make sure that the next trade makes sense. 100% on board with that. This is the other reason that I'm taking the same tack as Barry, staying put and letting it play out. It's not just that that's my normal way of trading, but also it does beg the question: if you're going to buy it back, if you are going to roll it, what are you going to do with the capital next? Don't roll simply to roll. Don't roll unless you actually know what you want to do with the capital once it comes back to you. Are you going to sit on it? That's okay. That's not bad. Are you going to work with the same stock, maybe with a different strike price or a different expiration? Okay. That's a good result. That's not bad. 35 cents is not as high as the 49 cents I brought in when implied volatility was a little bit more exaggerated, but it's still about 1.5%, a little over that for what is it, 3 or 4 weeks. So that's not terrible. Not sure I'm in love with it. Not sure that's good enough to make me want to place that trade. But if I'm not going to work with CTRA, is there another stock maybe on deck that I have been paying attention to that looks a little more attractive right now, that I could use that same that same $4,600 for? All of these are the kinds of questions that you should be thinking about. And even if you are by nature an active roller, the expectation should be that you have an idea of what you're going to do with that capital next. And this is not to say that you have to keep the money moving. It doesn't always have to be in the next trade. The decision can be, I'm going to buy it back, and that money is going to sit for a little bit, and I'm going to let the market play itself out before I make my next move. That's okay. I'm just saying you want to make sure that you've made that decision before you decide whether or not you're going to roll. Barry, cash sitting in the Schwab sweeping account is useless, so sitting on cash is useful only for prudence during certain market conditions. Yes and no. I get what you're saying, because you're not drawing any interest in that case, right? It's not like cash is going to accrue interest necessary. For some brokerages, cash counts and money sitting in cash does pay a low level of interest. Um, Gib, I keep seeing the Warren is sitting on cash. You know, some there's some wisdom in going to cash under certain market conditions, to be sure. I don't think that's smart necessarily to go all cash, but it may be a matter of deciding. I'm not really sure about what the market is doing right now. So if you're not sure about what maybe the next move is, then don't be afraid to sit in cash, right? It's okay to go ahead and just let that money sit. There is a mistaken assumption that if your money is in cash, that it's not doing anything, that your money is not working for you. That's not true. It's available. It just needs to be deployed. And having it available to deploy when you recognize an opportunity is just as good in my book as it is to have it actually out in a functional trade. Um, and I'm not talking about performance numbers here. I'm talking about mindset, and I'm talking about the ability to be responsive to what the market is giving us and taking opportunities as they come. If you're of the mindset that you always have to have a trade in place, that if that money is sitting in cash, it's not doing anything for you, then you're going to get more emotional about what's happening. You're going to press, and you're going to make bad trades. So not being afraid of cash is a way to reinforce a disciplined mindset. So Barry, that's why I agree but don't agree with you saying that cash is useful only for prudence during certain market conditions. Even in the most bullish conditions, sometimes I'll sit in cash just because things may be so chaotic in the moment, it's harder to make sense of it. And I'm going to leave that money in cash. I'm going to sit on it for a little while until things make a little bit more sense to me. I've done that with my Rebel income trades. You may see me from time to time saying, "Yeah, I'm going to hold off on a trade this week. I'm going to wait to see what things look like next week." I've done that on multiple occasions over the past years, and I may do it again. So, yeah, Gib. Again, that's just part of what I think is part of a disciplined system, is the willingness to do that from time to time, not feeling like you have to always be in the market. The phrase I like to use is not letting my money burn a hole in my pocket. I don't always have to spend it, don't always have to trade it. Sometimes it can just sit, and that's fine. All right. Good comments, though. Thank you. I appreciate that. All right. So the next put sell is on Comcast. This is like CTRA, another stock that I've used a number of times in the past. My last put sell, in fact, just expired last week. That was at $32.50, and I went about a dollar higher for the put selling trade that we placed this week. So let's take a look and see where we're at on that one. All right. So a little bit different setup going on here. So stock has immediate resistance right at this last pivot high, a little bit above 34, and it's been retracing over the last 5 days. That's what set up the opportunity to place the put selling trade. Major support is back at this pivot low, which coincides with the stock's low for the past year. Okay, Barry didn't place this week's trade. You were already in it at 32. So you've got a better price. You just didn't, maybe hadn't expired for you yet. Stock has been rallying off of that low at around 31. And we also have the 20-day moving average starting to bend upward a little bit and putting support at around the $33 level. So 33.50 is a little bit above that. And this one is a trade that expires on the 19th. So this is the third Friday of September. So got a little bit of time for that one to play out. That means the stock is close enough to that 33.50 price that it's unlikely to offer any real advantage in trying to make a move right now. I brought in 67 cents on this. Oops, wrong line. Sorry, 65 cents. 1.94% on the trade. So let's just go ahead and check in with it and see where it's at. And I need the 19th. The asking price on this is at 66 cents. So right about where I sold it for. So this is one. We'll go ahead and continue to let time work for us. Right, give us some time to keep playing around. Keep not playing. Excuse me. That's a term I don't want to use. But keep moving and keep letting the market work with it. Let the effect of time work in our benefit. This is the other reason that put selling and covered calls, being on the selling side of these transactions is so useful, is because time decay is a very, very real element for everybody who works in the option market, whether you're the buyer or the seller. Time decay is a killer for buyers. It really is, because awesome, Barry, your expiration's next week. So you're in a pretty good spot with it at 32. In fact, so Barry at 32, you could buy that back right now for 6 cents. I'm not saying you should or that you're going to. Obviously, it's going to be your decision, but that's probably interesting. That should certainly be quite a bit more than what you brought in from the initial trade, right? So brought in 58 cents. So you could buy that back if you wanted to close out that obligation, even if you weren't planning on placing something with that money before then. And if you're okay with it where it is, there is enough distance between 32 and 33.70 where the stock is at right now that you could say, I don't really have much in mind for what I would do for the next 7 days with the money, so why not leave it where it is? That's okay too. That is a very normal decision for what I do there too. So yeah, no worries on that. Going back to this idea of time decay though, the thing about time decay for buyers, this is one of the reasons that I kind of soured on buying options at all, is time decay is a constant element. Every day that passes, and I'm not talking about days the market is open, I'm talking about every calendar day that passes, time decay is taking effect on these options. Here's the proof. Let's look at this options chain. Let's just go ahead and, since the stock's at around 33.70, let's talk about the 33.50 strike price. And make a note of these numbers for both the calls and the puts. $52 on the bid for the call, 31 for the bid on the put. Okay. 33.50. 68 on the bid for the call, 47 cents for the bid on the put. Okay. See how it's shifting. These are just weekly numbers. Now we don't have the 33.50, so let's work with the 33. Again, there's how that is impacting. We go to 35. You can see time. Here's 32.50 again, going out a couple of, little over a month. You can see time really having an impact on what the overall prices are for these options. The more time you're working with, the higher the price is. Now, as a seller, that's tempting to say, well, then I can bring in more premium. But when you think about that on an annualized basis, you're still doing better by working with shorter expirations. The thing is, for the buyer, these numbers mean the more time you buy, the more you're going to pay. But it also means that you have to be right about where the stock is going in the time period that you've got. Every single day here, every single day that the stock trades, no matter what the direction is, time decay erodes a little bit of the value of that contract. When we hit the weekend, the market closes today, tomorrow, all of these option contracts are going to lose a little bit of value. Sunday, all these contracts are going to lose a little bit of value. Monday's a holiday, the market is closed. Guess what? All the contracts are going to lose a little bit of value. There's no price action. There's no price movement during these next 3 days that I'm talking about, but they're all going to lose value because time decay is that constant and is always taking place. That means that if you're buying options, you have to not only be right, but you have to be right on time. And if you're not right on time, and I'm not talking necessarily about just before your option expires, I'm saying if you're not right almost right away, time decay will very often erode the value of the contract, that even if you do get the movement that you want late before the option expires, a lot of times it's not even enough to actually give you a profitable result. You may do well just to break even on the trade, even if the stock moved $4 or $5 that maybe you were hoping. I've seen that. I've had that happen in my own trades multiple times. It was really frustrating. So if that's true for the buyers, again, logically flip the script. If that is putting buyers at a disadvantage, then it is creating a very clear advantage for the sellers. And by working with the shortest time frames possible, I'm accelerating that time decay effect even more. That's why I don't sell, as a rule, more than 30 days. It's very, very rare when I do. I might go out 1 week past 30 days, but that's about it. Because I want that time decay element to keep working for me. All right, Barry, thank you. I meant to write a covered call on NLY. Perfect segue. That's awesome. Thank you. I appreciate that. And really quickly, just want to check in on the cover call on Schlumberger that I mentioned at 36. And stocks continuing to show some nice momentum here. Oops. There we go. Pushing up above 36.65. So everything's looking nice for that covered call trade. And that expires next week. So it looks like I'll probably be called out. I may be sacrificing some upside here because I sold the 36. We'll see. Stock could just as easily start to retrace here. We've got we've got a stock, it looks like it's expanding its consolidation range a little bit. Previously, it had been about here and here. And now it's here and here. So we'll see, but it could easily start to retrace. Boom, boom, boom. So we'll see if this calls me out or not. Barry 912 call, so also same expiration for 65 cents. Nice. Barry. 1, 2. And then let's do your NLY. Annaly Capital Management. Okay. I am not familiar with this, so by way of disclaimer, coward's door, whatever you want to call it, what we're talking about now is not a recommendation to buy or sell. I cannot speak to the value proposition for this stock. It does pay dividends, which is nice. But let's go ahead and take a look at the pattern and let's see what it's doing. Barry, you did. You sold the same strike price that you bought at. Okay. I'll go ahead and give me one then. All right. So NLY, some of the things here really quickly that are interesting. Obviously, an upward trend is an interesting thing to see, right? It's rebounded from about 1650 at the very, very low point, coming up here to 21. So it's got a lot of bullish momentum going on right now. And the distance between the 20-day moving average, which is here, and the 200-day moving average, which is just a little bit below 20, is starting to expand. Well, I shouldn't say starting to expand, is expanding. It's an active state of expansion right now. Barry says it's pretty much a good and solid cash machine. Capital management and real estate investment trusts. So a lot of these are built exactly the way that you're talking about, Barry. Again, I haven't reviewed this, but REITs are typical of being companies that are set up to own and manage real estate investment properties, and their dividends are usually a little bit more attractive than what you'll see on most stocks. In fact, let's take a look here. 12.86% for their annualized dividend. That's interesting. Options are not good, but the yield is good. The yield is very good on this. A lot of these won't necessarily have a lot of movement in the options market. Barry is in this at around 16, so you bought all the way down here. And maybe if you didn't do it in April, you would have had to do it much longer. Maybe back here in 2023. Very good yield. With REITs, this payout ratio, this looks kind of scary. I kind of take that with a grain of salt because these are built specifically as income generators. These are designed to pay dividends, and the payout ratios for these tend to be a little bit more skewed. But it is showing a lot of momentum, and covered call at 21, which is what you said. I'm sorry, 22.50. So you set it up here, even above the top of the stock's range, which is at 22. That's nice. And you're in at 16, so that's a $6 gain if all of this momentum continues. It does look like it's starting to taper off, right? We've got Clear resistance here, 21 and change, call it 21.25 for the sake of argument. And it is fading just a little bit off of that level. But if this support from the 20-day moving average can hold, then it may continue to follow the same trajectory. Considering the slope of this trend right now, this is hard to maintain. So I wouldn't be surprised to see it, I wouldn't be surprised to see it retrace a little bit, maybe come down towards the 200-day moving average and then bump up. I'm guessing, Barry, even if it does that, it's not going to bother you too much. You're in at 16, so reinvesting your dividends, so it's been ratcheting down your cost basis. Start on it back when it was up around the price it is now a couple of years ago. Okay, so you've held this for a long time, and you've been able to lower your cost basis through those dividend reinvestments. That's awesome. That's pretty cool. I'll give this one to you, Barry, happily. 2, 3. Again, I can't speak to the other details for the company, but if you've gone through that analysis and that makes you comfortable, this is a nice result. This is a good result for that stock. So, good job, awesome. If you hold it for a couple of years, then you're obviously comfortable with it. So I like it. That's, there's nothing to criticize about that result by any stretch. Let's just go ahead and take a look here at the options. Got a couple minutes left. They did a reverse split. I got it when it was down in the $9 range. Okay. Even better. NLY. So go ahead and assume you bought the stock now. Again, not a recommendation. Let's go out 4 weeks to start. The $21 strike, 33 cents for a put sale. That's not horrible. I don't love the spread, and that's going to tell me that there's probably, not a lot of open interest here to work with. But the 33 cents by itself is not terrible. The covered call at 21, a little bit in the money, looks a little bit better, right? 44 cents on the bid there. $22.50, you'd have to go out for a little bit of time on this, out past 60 days, it looks like. But even at 21, there's some possibilities. 21.50, there's a pretty steep drop between these two, right? So that doesn't make 21.50 super attractive. Big drop off even just from 3 weeks to 4. And here's 39 for 3 weeks. A little under 2%. And 2 weeks is probably not as great. So I don't know. These are interesting numbers, to be sure. And for where you started at, looking back to your history, you bought it in 2021. Okay. For where you started, this is actually working out pretty nicely. Yeah. Any of these covered call trades wouldn't be ugly. for where you were when you started the trade. So that's a good result. That's awesome. That's something to like, Barry. Thank you for sharing that. I appreciate it. All right. Well, we are at time, so we do need to go ahead and wrap this up. But I do appreciate. I took a lot of the dividends before I began reinvesting, and that's okay too. It's a good dividend paying stock, just on the basis of what we've seen. So um, thank you, everybody. Appreciate your time today. As always, please, if you find this session useful, please share it with your friends. I used to keep this live stream private. I'm only sharing it with those of you that were already part of the Rebel Income community. I'm now doing it public because I'm trying to be frankly to bring a little bit more awareness and exposure. So feel free to share this with your friends and get them. Feel free to invite them to come and participate as well. Um, in any event, I hope you have a great weekend. If you have any questions between now and next week, don't hesitate to let me know. rebelincomesystem@gmail.com is my email address, or you can reach out to me on Discord if you're on that platform, or you can message me in Substack. Thanks again. Really appreciate your time. Talk to you next time.